Okay, well, welcome. Good afternoon, everyone, and thank you, Patrick and Infinity Futures, for inviting me back for. I think this is our third webinar now with the Infinity Group, and I appreciate the opportunity. And again, I welcome everyone that's taken the time out to come visit with us today and attend the webinar. Today, our webinar is going to be. I'm going to discuss something that I think is fairly unique in terms of how we approach it. It's our adaptation of a technique in probability thinking. So many of you have out there have read many various books and so forth, and you've always heard the topic about that. In order to be a successful trader, you need to think like a professional. Okay, so what we've developed here is a technique in terms of thinking in terms of probabilities, all right, throughout the course of the session. So before I go any further, I do recognize many names that are in attendance today. Some I do not recognize, so hello to those that are not familiar to who I am. And just to give you a little brief background of who I am, I'm a 30-year trading veteran of the various investment banks and hedge funds. And those include Lehman Brothers, United Bank of Switzerland, UBS, some high-frequency hedge funds, and I was a market maker and listed in NASDAQ stocks while during my years over at the investment banks. I've traded various products from index futures for them, derivatives, and I've been heavily involved in various aspects of portfolio risk management. All right, so that's who I am. I want to get right into the topic today, and again, this is a little different topic than perhaps various webinars that you've been. What I want to get into is talking a little bit about probabilities in and of themselves. And again, this is not going to be real technical. There is some details in here, so bear with me in terms of getting through the material. But I want to get through some of the core details of the method and the technique, and then we'll get to some charts, and we'll see how I'll demonstrate what we do on a day-to-day basis within our trading room with these techniques. So essentially, the trader's edge, right? The trader's edge is thinking in probabilities. But what does exactly, thinking in probabilities mean? All right, and again, why is it essential? All right, everybody, you've heard it over and over again. You've read it in various books and articles, and thinking like a professional trader, thinking in probabilities. But how do you do that? How does that help you? How do you need to think to become a successful trader? Okay, and how can we produce consistent results? All right, that has, we know trading. Every time we put on a trade, we don't know whether that trade is going to work or not. So there's uncertain results of what that trade's going to produce. Whether it be a winner, small winner, big winner, small loser, big, hopefully not big loser, because you'll have a stop loss management in place. But each trade is nothing more than a probabilistic opportunity. Okay, and simply probability means that one outcome is favored, has a greater likelihood, all right, of occurring over another. So for instance, if you're in a uptrending day, so let's just take yesterday for instance, right? Very, very strong uptrend. Well, the probabilities of a strong uptrend continuing favored the long side. All right, so for those out there in the world that were shorting yesterday's action, didn't have too much fun. All right, but they were not favoring the higher probabilistic outcome, and many times that's a result of various beliefs and views about the marketplace and so forth. But beyond that, each trade, each opportunity is nothing more than a probability opportunity. Okay. Now, with that, how can we generate consistent results? Now, if you say on one hand, that each outcome is uncertain and random, well then how can we generate consistent results? So that's a bit of a paradox, okay? And the real great example that I like to use, and I've used this presentation in our workshops that we hold on Wednesdays, is the casinos. So if you think about all those casinos, they make consistent profits daily. Now they may not be huge percentage-wise, but they have an edge. And what they're simply doing is facilitating a random, games, right? Blackjack and baccarat and all the various other ones, right? Roulette and so forth. These are all random outcomes, but they have an edge. All right, and so most traders believe that the outcome of the market's behavior is really not random. Why do they not think it's not random? Is because they're putting their beliefs into it. They personally believe that they know what the market is going to do. So when they instill their beliefs on what their view of the market, and the market does not conform to their view, all of a sudden they can't seem to produce consistent results. Okay, but they're viewing it wrong. Okay, they're simply viewing it wrong. You have to kind of take the viewpoint of professional gamblers. All right, so as I state here on the slide, here's the key. All right, the casinos experienced gamblers, the best traders, and the best traders have an understanding that the typical trader does not. Simply that the events have probabilistic outcomes and can produce consistent results if you get the odds in your favor and there's a large enough sample size. So the best traders trading, similar to gamblers, just as a numbers game. All right, but what they have in their favor is an edge. That could be their particular methodology. Okay, that they've worked hard on, whether it's their own personal methodology or they're in an education room such as ours, that our traders are employing a methodology that has consistent results. And again, we'll show several of the trades today that we had opportunities in. It was actually turned out to be a very nice day opportunity-wise, and with the increase in the volatility and so forth. But essentially, it's a way of thinking about trading. It's a way of thinking about each individual trade. Okay, don't impose your views. Rather, accept that the market can and will do anything. How many of you in the past have thought about, oh, the market is too high, it can't go any higher, only to see it go up another 5 or 10 handles or more? Okay, you're imposing your view on the market because you think it is quote unquote overbought. Well, my background is from the investment banks. I can assure you that the investment banks, okay, I was never taught that the market was quote unquote overbought or oversold. All right, what the investment banks and how I was taught was viewed that the market reaches statistical extremes, both to the upside and to the downside. Statistical extremes, i.e. stat X is what we talk, the short term for it, those are measurable. Overbought and oversold can stay overbought and oversold for days and weeks and so forth, but statistical extremes are truly measurable. And so just like the casino, the investment banks have a strict methodology of what determines what is statistically extreme. So there's an edge there, okay, and they exploit that edge, all right, to the detriment of those that don't have an edge. Okay, so those are the novice retail, I just like to call them two groups: the informed traders and the uninformed traders. So which group do you would like to be on? Informed or uninformed? Do you feel as though you've been uninformed, all right, over the months and years? Well, our traders in our membership are becoming more and more informed with the education that we provide. All right, so in essence, the trader's edge is thinking in probabilities. But again, this is just some of the background that I'm offering right now. What I want to do is get a little bit more into the detail, all right, of the techniques, okay, that we use. So again, comparing blackjack to trading, all right, you can just see the table here where, we need to develop a new belief, all right, that is simply contradictory to our thinking, okay? So in terms of blackjack, and I like to use that example, all right, because it's simply, win, lose, or draw on those, right? So if you think about, you're sitting at the blackjack table and the cards are coming out, okay, well, you're either going to have, good cards up, or not, and you're either going to fold or you're going to, you're going to be a winner on that hand, okay? So simply win, lose, or draw against the dealer, all right? But again, the dealer has an edge because he is not simply playing one-to-one, all right? There may be 5, 6, 7 people at their table, and effectively, the dealer, all right, plays their hand exactly the same way each and every time, all right, without fail, okay? Whereas the players around the table, okay, they think they know what to do. They think they know that they have an upper hand, just like the trader knows that he thinks he knows what the market can do and where it's going to go. All right, so he gets cute, but yet he finds he has inconsistent results. All right, so the rules of the game in blackjack is simply that the house must play every hand, no exceptions. Okay, but they also know that for each hand played, there's going to be an unequal distribution of wins and losers. All right, but yet on a collective basis, over the course of a game, over the course of several games, a multi-shoe deck game, okay? In fact, the opposite is true. If the odds are in your favor, okay, then the law of large numbers, many of you have heard that, are actually in your favor if you play, and again, I'm going to stress that, if, capital IF, if you play your hand the same way every time, okay? So if you have a combination, if you have a 16, do you hit on it, do you don't hit on it? Again, it will depend upon what the deal is showing, so forth and so on, but you have to play your hand every same way every time, okay? And so same thing with trading, okay? Bottom line is if you have enough consistent patterns, all right, then there will be a statistically reliable outcome. So the trader's edge is simply his methodology, okay? So it's our methodology at Polaris, could be somebody else's that they have out there, all right? But the rules are basically the same. Trader must execute every trade setup defined in his methodology. The trader cannot say, well, I don't know if this one is going to work. I'm not so sure. If the criteria is valid, all right, then they have to take that trade. If they choose not to take that trade, then what they're actually doing is destroying the methodology. What they're doing is destroying the law of large numbers, okay? As day traders, and I assume primarily everybody here is a day trader, day trading, you want as many opportunities as possible, okay? And with these wide, range days that we've been having and increased volatility, we've been really, having some fantastic opportunities, all right? Unlike, we saw in the summertime where we have very narrow and slow volume, okay? We want to embrace what we're getting out of the markets right now, because again, it may not last that long, and that window of opportunity closes. So if you have a solid methodology, you really have to exploit it. Don't think about it, that you're taking money from somebody else out there. They're trying to do the exact same thing to you because, zero-sum game and all that. But you want to exploit the market. You want to exploit your opportunities. All right? So that simply means that, you have to take every trade. All right? But again, each trade, just like in blackjack's, unequal distribution of wins and losses. And that's where a lot of people have a big problem. All right? Is that they don't understand that you can have 4 losers in a row, okay, on any type of methodology, yet on the 5th opportunity, if it's a valid trade setup, many novice type traders won't take that trade. Yet a professional, knowing what the odds are, knowing that his method has worked consistently over a broad time period, over a large sample size, they will take that fifth trade. And that is really the difference between a professional and a novice type trader. Okay, that's the difference. Now, what you want to get, if you've been having trouble taking that next trade because of a single or multiple losses, this is where you have to jump that fence. Okay, and the technique that we're going to show is to help, all right, get over that fence by focusing on the relevant information that is required. All right, now again, you know, I know many of you out there are reading Twitters on the stock twits and watching perhaps CNBC or blogs and so forth during the day. Okay, I would highly recommend that you absolutely stop that right now. All right, and start focusing on what's in front of you. Price action and your methodology. Okay, so that being said, both the casinos and professional gamblers do understand that the nature of probabilities, all right, and each individual hand played is statistically independent of each other. All right, so what happened in the last trade has no bearing on the opportunity that you have in front of you now. And so whether you win, lose, or draw, okay, on this current trade, all right, has no bearing on whether or not you're going to win, lose, or draw on the next trade. Okay, so you have to take each opportunity. It's just like sitting there playing blackjack, getting dealt the cards, win, lose, or draw. All right, $2 table, $5 table. Okay, you place your bet, and you know you if you play correctly, even when you play correctly, all right, you've made the correct decision. There's no guarantee that you're going to win. Right, and so the odds really of a good, solid trading methodology far exceed the odds of blackjack. All right? Again, the house has the edge. The player doesn't. Okay. Here in trading, at least with our methodology, we have a extremely higher, you know, edge than anybody that's playing blackjack. But I do like the comparison. So that simply means that, you know, for each trade, it's a unique event, and you really have to kind of wrap yourself around that idea. All right, and if you've been having trouble or haven't even thought about it that way, you have to start looking into, you know, what that's about. Okay, and so, you know, random outcomes, okay, relative to the last hand or the next hand and so forth, okay, are random, but over a large series of trades, if there is a statistical edge, okay, they will produce consistent results. So that's kind of the background of the paradox. All right, now. Okay, how do we move forward, okay, to developing a logical approach to thinking in probabilities? All right, and a lot of it has to do with how you know, computers are programmed. All right, all these algorithms out there that are running amok in the marketplace. Some statistics now are saying above 70% of the trades are being executed by algorithms. That's probably true. Okay, so but we have to develop a logical approach. So there's an input-output loop, right? And simply, you probably heard this, you know, many years ago: garbage in, garbage out, right? So every day we're bombarded with unlimited amounts of market information. The internet is, you know, flowing with abundance of information. There's a lot of actual disinformation on the internet. So you actually have to seek out sources of information that are relevant to what you want to accomplish as a trader. If you're a stock trader and earnings, price earnings and ratios and fundamentals are important to you, you need to seek out competent sources of information. You just can't simply take what anybody says out there. You need to make sure that they're qualified and you respect and they have, you know, some history of successful information. Okay, and you know, good track record. So prices, earnings, news events, opinions, all that stuff that's out there, you know, literally for free, littering the internet. Okay, we're just bombarded with that stuff. So, you know, we need to develop some type of a technique that filters the information that's most relevant to the specific decision that you need to make day-to-day trading. and simply discard all the rest. So this is why I say to my, the traders in our trading room is that if you're watching CNBC, you're not paying attention to the screen. If you're listening to them in the background and you're not necessarily watching them, you're not paying attention to what's on the screen. If you're reading a Twitter blog, you're not paying attention to what's on the screen. Okay? These are a lot of distractions that occur throughout the day. All right? I myself experience an enormous amount of distractions, all right, as a professional trader, educator, moderator. I mean, there's a lot of moving parts that are going on in my world on the opposite side of the screen, yet I don't have a Twitter blog, nor do I have a TV on. Okay, as a matter of fact, what I usually have running in the background is some light music, okay, to kind of just the background, elevator music as you want to call it. All right, so the decision process is simply an endless loop. All right, information is being fed to you. You need to parse that information and take what you need, take what's relevant, and get rid of the rest. All right. So what we've done here is we have adapted a decision technique. Okay, and we simply call it the PTG, Polaris Trading Group, OODA loop. Some people use the term OODA loop, I suppose, but we call it OODA loop decision matrix. And simply, you'll see what it stands for. All right, observation. Hey, eyeball analysis. Look at the charts. Do we get higher highs, higher lows, lower highs, lower lows, double top, double bottom? What's going on? Okay, just describe in layman's terms. All right. Once we have observed market action, and it could be not just the chart, but it could be a variety of different statistical data points that that you're looking at and that you believe is going to help you as part of your method. Then you got to orientate that. You got to take all that information and say, okay, so where am I? Am I long? Am I short? Should I be long? Should I be looking for a short? What's the deal? Okay, is the trend up, down, sideways? Context is extremely important. All right, and I show this and I discuss this daily with our traders that a particular buy signal that we have, okay, at one point it could be the exact same price. That a little bit later on, at the exact same price, it's not a buy, even though the same signal is firing. Because in the first signal, we had, take for instance the long opportunity, that first signal was producing, the context was strengthening uptrend type conditions. Whereas at the same price point, that signal may refire, give us an alert, but the context, it's a weakening condition. So do we want to absolutely automatically take that trade? Well, we want to be buying in strengthening conditions and simply avoiding the long side, right, in weakening conditions. But we need to know what those conditions are. We need to, be able to have some context of, how do I know they're weakening? How do I know they're strengthening? All right, a lot of that is important. Once we have our orientation, okay, so like, simply, all right, I'm a pilot, okay, and I've trained private instrument conditions. All right, I'm an instrument pilot. I'm a commercial pilot as well. So orientation is important, especially if you're in the clouds. All right, and you can't see the ground or anything in front of you or behind you or anywhere. All right, are you up, down, sideways? You need to know. If you're in the proper orientation to the earth. Okay, so in trading, it's really that important. Okay, now in flying, it's life or death importance. In trading, it may not be life or death, but it's simply financial life or death. So it is very, very important. Well, once you have that orientation established, right, then we get into what we call our decision and action cycle. And we're going to get a little bit more specific detail here very, very soon. Long, short, sideways, what entry price, what's the stop loss, position size, all those variables that we need to have already predetermined, throughout a trading plan. And then once the opportunity arises, the trade setup, if you will, we need to know what the action to take. Am I going to take that action? Am I going to buy it? Am I going to, what am I going to do? And there's a feedback loop. that goes on with this observation, orientation, decision, action. It's constant feedback loop. All right, and in terms of the action cycle, you're going to be simply asking, if this happens first, all right, then do X. If this happens, if something else happens, then do Y. Otherwise, or else stand aside and continue watching. So it's kind of, wash, rinse, repeat. So let's get a little bit more detail. I want to give you a little bit of background now on the OODA loop. And as I mentioned, we have adapted it. We were not the developer of it. Okay, the developer of the model, the OODA loop model, was Colonel John Boyd, United States Air Force. He is deceased. He was a fighter pilot during the Korean War, and you can Google him if you'd like, and you read a little bit more about his background. But the looping concept simply referred to the ability at the time possessed by fighter pilots. Now again, if you think of the activity of what's going on here, all right, talk about a life or death situation. Okay, you're in a dogfight with an enemy. Okay, and so you better have your top of your game, or you're going to be shot out of the sky, right? Very simple. So it's it's simply life or death. But basically, it was the ability possessed by the fighter pilots that allowed them to succeed. So the premise of the model is really that decision making is a result of a rational behavior in which problems are viewed as a cycle of observation orientation, which simply we call situational awareness, right? Decision making and action. So the model here is a looping circular, and it's never ending. It's constantly looping, and most of the time throughout the day we're in the observe and orientation cycle. So if you actually visualize an inner loop between observe and orient, observe and orient, observe and orient, so that's kind of constantly moving. And then when it's time to, when there's an opportunity that has arisen, now you get into the decision action cycle. So once you've decided to take a trade and you've made the appropriate trade entry, then the observe and orient kind of cycles again, but this time it's more for verification of that trade. All right, is it still valid? Is it not? Okay, what are the parameters and so forth? And again, what I do during the day for our members in our trading room is through my moderation, I verbalize the OODA loop quite a bit. Okay, and it's simply trying to keep everybody focused on the relevant information of what's happening, at the time with everyone. Okay, and again, as human beings, we have a limited, source of energy, right? The reason why algorithms, all the big institutions use these algorithms is simply they never sleep. They don't complain. They don't ask for a raise, right? They just do what they're instructed to do. Never-ending, endless loops of if, then, else, do this, do that. If this criteria is true, then go do something else. And they just do it routinely, but obviously, in light speed. But at the core of it, though, they're just going through a looping, endless type of looping process. Okay. As humans, we have limited capacity of energy and so forth. So if you're constantly expending energy elsewhere, then it's going to be difficult when it comes time to actually focus on trade opportunities, to take those trade opportunities, because you're going to be exhausted. All right. So we want to, use our energy reserves to the greatest capacity. All right. So here's a little bit more of a detail of the OODA loop. All right. So we simply want to scan the environment, i.e. the market action, and gather information. That's the observation part. All right. And simply we want to kind of synthesize it. All right. We want to take the good stuff, and discard, the information that's not going to help us. Okay. So if you recall, as a driver, okay, years ago, all right, it took a lot of energy to, to learn how to drive. Okay. And then as you've gotten, you got better at it and more experienced, then, there was a natural kind of, you're looking outside, all right, you're going down the boulevard and you're waving to people, and your attention span is expanded because you're in a looping process. Your orientation, your observation is is kind of in auto mode. Okay. All right. But it's really garbage in, garbage out. So you want to make sure that we emphasize the information that you're bringing in on a day-to-day basis. And again, how many of you have ever put on a good trade? Be truthful to yourself. You don't have to answer to me. Getting something from StockTwits, right? Getting something from CNBC, of all places, right? Have you ever put on an intraday trade because you saw something on any of those media that you were able to put on a great trade? I think not. So it's important that the information that we're bringing in is relevant. All right? It's information that's useful. And if it's not, get rid of it. It's a waste of energy and a waste of time. Now, many of you have read or heard the phrase, trade what you see, not what you think. Very popular out there. Trade what you see, not what you think. Well, there are aspects of that phrase that is very true. We want to trade what we see, not what we're thinking, because our thinking generally is flawed. But here's the rub on that I get. What happens if you truly don't know what you're looking at, or you don't know what you're looking for? Right? Many of you are developing traders. You haven't developed a methodology. You haven't really gone through the process, all right, of trial and error perhaps, and okay. You're looking for, and somebody says, hey, did you see that? And it's like, I don't even know what you're looking at. Okay, I don't even know what you're looking, So if you don't know what you're looking at or looking for, then how can you trade what you see? Because everybody seems to see something different. Buyers see something and sellers see something, all right? Well, although, again, as I mentioned, there's aspects of that are true, what we have done is we simply say, trade what we know or trade what you know, verify what you see. So that is based on the premise that you have a knowledge base of information, relevant information, statistical, backed information, back-tested and so forth, battle-tested for that matter. All right, I don't even like to talk about back testing. I talk about battle testing. All right, in all types of conditions. So once we have a core understanding of that, all right, so we want to verify what we see at the time. So then we go into the decision. Again, you want to consider your options, subsequent course of actions, i.e., simply trade setups. And then once we have that, we want to carry out that decision. All right, we want to carry out the decision without thinking about it. So people, you've also heard say, just trade, don't think. Okay, well, that's really kind of when you're in the action cycle, part of the OODA loop, you're just taking that trade because it becomes automatic. All right, and I'll show you some cool things with the Sierra chart that we can do day to day, or even on weekends. It's a great, the replay feature. I don't know about how many of you have used the replay feature. It's an absolutely fantastic way to review, and test, ideas out and so forth. But all right, so let's get a little bit more into this. All right, so again, bear with me. It's really important. I'll try to get through this as quickly as I possibly can, so we can get to the charts. I always look at the charts as sign of the fun stuff. All right, but just let me bear with me. Look at a little bit more detailed view of the decision cycle. All right, so in order to think in probabilities, in terms of probabilities, okay, now that's at the outset of the presentation we said that professional traders think in probabilities. So we want to emulate what the professional traders do, right? That's what we're told to do. But nobody out there has really given us a template. I'm providing, hopefully, a template for our members and anybody that's out there that's interested in learning more about it, all right, to come in and visit with us. To learn more about this type of template. But to think in terms of probability, you simply got to think like a computer. All right, we talked about the algorithms. They run the world now. Well, shit, if they're running the world, let's ourselves emulate, Now, we can't do it as fast as a computer, but what we can do is we can simply take simple instructions, our own self-made instructions, and then apply them to our own individual trade. Now, we will never be as fast, all right, and we will never compete at the level of the algorithms, because the only way you're going to compete is you become an algorithm, okay? But at the end of the day, all what these algorithms are about, okay, simply are instruction sets, conditional statements, all right? They're very complex, and there's just numerous types of algorithms out there, but simply they ask the same questions, or what's called a conditional statement, over and over again in a looping process, and they just keep going, all right, and so forth, okay? So the statement is in the form of if, then, else, conditional statements. So many of the statements that we make, in proven mathematics are simply in the form of if P, then Q, all right? So my wife, in preparing the slides, she said, well, you better mind your P's and Q's. So I don't know. So I added that in there for a little smile. But not to get into the mathematics of anything, all right? Again, I want to go beyond mathematics, but simply that, you want to prove that something is right. So if there's an assumption that if this happens first, what is the most likely outcome? All right. So if task A happens first, then A1 is going to be the more likely outcome based upon historical occurrences and observations. If B happens first, then B1 is going to be the most logical outcome. Okay, but we don't know which one is going to be happen. All right, so simply, it's a way of critical thinking. All right, and that we want to we make some inferences and assumptions, but in doing so, we don't want to make predictions. All right, I don't want to predict if the market's going to go up or down. I will, and we say every day in our trading room, and people have visited with us, and they say, what do you think the market's going to do? Where's it going to close? They say, I have no idea. But I'll tell you, if it's going to go down, we're going to be going down with it, and we're going to be able to recognize at what point the market made the decision to change, okay? And we will show you actually an example of that. So essentially, if P, then Q. So you need to prove whether or not P is true, and if P is true, then you have to conclude that Q is true. This is what are called proofs. Now again, I don't want to get too detailed with that, but just to give you a little bit of background of the decision cycle. So moving forward, then, if then else statements, are to keep traders thinking in probabilities, then we have to learn how to use these statements in terms of our day-to-day observation of the market, orientation of the market, all right, and so forth. So once you've observed the price action, like we discussed a little bit earlier, you've orientated yourself long, short, what's the market bias, bullish, bearish, etc. Okay, you move to the next, part of the looping process is the decision. And then this is where the meat and potatoes kind of come in with, focusing our attention on relevant information and not being distracted by irrelevant, input. All right, so when you're looking at the charts, all right, you're looking at it, well, there's obviously, the markets are either going to go up, down, or essentially sideways. Well, which is going to happen? Well, don't try to predict what's going to happen. It's a waste of energy. But if you format it in your orientation and observation in a way of saying, well, if this happens first, if this high gets taken out first, well, what, again, if P, then Q, right? So if the high gets taken out first, what does that imply? And I'll show some examples in just a moment. We'll get into the next slide. All right, so if, then, else. It's a very simple formula, All right, and then we talk about it, and I actually write about it in the prose that I write my daily trade strategy every day, and you can view that on the blog section of the website. Those are the archived daily trade strategies, and many of you have received recently this month. I basically frame out the market, upside opportunities and downside opportunities, in this type of format. All right, and it's very standardized. So again, as an example, if the price makes a new swing high, right, NSH, then you want to buy a pivot pullback. If the price does not make a higher low pivot on the pullback, right, then what do? Well, maybe then the decision is you're going to stand aside and reassess the situation. Okay. What happens if it doesn't make a new swing high? What does that imply? I spoke about that this morning in the daily trade strategy. Okay, and as a matter of fact, that was the premise of our reversal today that we saw. I think it was around noontime, a little bit after noontime. As a matter of fact, it was during noontime because I was just taking a break for lunch, and I highlighted the opportunity that the market was experiencing weakening condition, and there may be an upcoming reversal. And then I went to lunch, so I missed the early part of the reversal. But okay, so let's just go a little bit further, and I'll give you a graphical example of what I'm talking about. Right now, this may make a little bit more sense to you rather than just looking at text. All right, but this is a graphical representation of the if-then-else decision cycle part of the OODA loop. So simply, right, if price makes a new swing high, NSH, then normally, sometimes the market just runs away, but normal market action shows that after a breakout attempt, market pulls back a little bit. So it's then on that pullback. So you said, well, there was enough energy to break up through a consolidation pattern. Now I'm looking to buy a pullback. Okay, and everybody absolutely agrees 100%. Yes, I want to buy the pullback. But they don't know how to buy the pullback. All right? They end up getting in too early, or they're too impulsive, and but there are, again, we have additional techniques, more mechanical techniques to get in, simply called the right side pivot rule. Okay, RSPR for short. But that's not the subject of today's presentation. It's more that the idea of framing out the idea of, if this happens first, okay, then I want to buy a pullback. So if P, then Q. All right. If it doesn't make a higher low pivot, then what do? In other words, all right, in the example here, okay, you see that on the first example, you see the price pushed up, right, and then it pulls back. So the blue lines represent the breakout and a valid pullback, meaning that it made a higher pivot low, pulled back into the range a little bit. All right, buyer stepped in, it pivoted back up, and then the expected outcome was a higher high. So it's on that pivot, all right, that the probabilities, so we're thinking about trading in probabilities, the probabilities favored a higher expected outcome. But if on the retracement after a new swing high fails to produce a higher pivot low, guess what? All right, boom. All right, lower low, maybe that equals stand aside till there's more information. Okay, now the way the OODA loop works is it's constant kind of this process where you're observing, you're orientating, but you have a framework, trade what we know, verify what we see, of exactly what to do in the event that you see a higher pivot low following a new swing high breakout. You know exactly what you're going to do. So you're already prepared to take that action when that event occurs. So if P becomes true, then Q is the expected outcome. And there are measurements for that and so forth. What happens if price doesn't make a new swing high? So on this next example in the middle, price fails to make a new swing high. What does that imply? Okay, we see that over and over again. Now you can apply this to daily ranges, daily highs, daily lows, intraday highs, intraday lows, the opening range high-low, the initial balance, which is the first hour high-low. You can make all the same inferences that we're doing here generically to any particular time frame or tick size, perhaps, or just simply price range. All right. So what happens? You're going to assume if the price doesn't make a new swing high that the price will more likely it's going to come down and test the lower end of the range, and then the looping process yet begins again. What happens if the low holds? What happens if it does not hold? Again, these are questions. Now, keep in mind, this is what algorithms do all day long, sleepless. You and I, though, how many breakouts have you missed in your trading career? How many good, great setups have you missed in your trading career? However long it is, right? I can't even count how many. There's so many, all right? Why? Because simply, I might have just been, in the ozone at the moment, or I was distracted doing something else, or whatever. But when I take a break, I step away from lunch, and I come back, 1 o'clock, 1:15, back to the trading room. And by the way, we're open all day for those that, are out there, okay? When I come back, before I just sit down and, start clicking on the mouse, I orientate myself. I go through my own kind of set of, OTA looping, as I call it, and what is the market doing? What did it do while I was away? And I came back today and I sat down and said, wow, right? Price broke down, right? But I was able to catch, part of that on the way down a little bit later on, but I didn't catch the initial break because I had walked away. But that's what, that's what happens. So again, use these as some visual examples. I'm going to go into the charts now. I think that's the fun part, all right? And I'll show you exactly kind of things that happened today. And Patrick had mentioned some of the new features that they're offering with Sierra Chart with the number bars. And I'm going to show you some of the, there's so many permutations and setups that you can actually do. I'm going to show you, one or two of mine that I've created that actually is pre-templated for everybody for the most part, and it's in conformity to exactly what we do. So I've basically taken the number bars and put them, kind of fit them into what we do for trade setups and so forth. So, just the last example here before I move on. I mean, you can just read that and kind of, interpret it. Right, if the lower level holds, then look for a price to make a new swing high. Look for a potential breakout. If it doesn't, look for retests and so forth and so on. Okay, so again, I don't think there's anything here that is new to anybody. And again, I'm not here to reinvent the wheel for anybody. What I'm here is to help provide a logical framework, okay, of thinking in a very chaotic environment. All right, that all of us, it's a very emotionally charged, psychologically driven, okay, environment, and we need to be as focused as possible on the relevant information. That's the core of everything that we do. That's why, again, as I suggested, get rid of the irrelevant information, and you make your own personal assessments of what's relevant or not, okay, to your own particular trading. All right. So let's go to, let me see if I can change the screen here. Everybody should be seeing the Sierra Chart platform. Okay. And let me just describe a little bit. Okay, we are great. Thank you, Patrick. All right. So let me just describe what we're seeing over here, and this is taken actually from today's trade, so it's relevant and timely. Everybody's familiar with the New York Stock Exchange tick, all right, NYSE tick. That's in the top left. The window down below is actually something I just recently created new, and I asked Patrick about it not too long ago, about less than a week ago, and I didn't realize that Sierra Chart actually had it. But this is the advanced decline ratio. So that's the net advancers, right, divided by the net decliners, and this gives us a single line that this is the net ratio. Okay, so anything above 1.0, that means there's greater advancers are relative to decliners, okay, and it's on a ratio basis. So that's what you see over here. This becomes a very useful tool. All right, I think some of the two most useful tools in terms of reading market internals, all right, intraday, is the advanced decline line, right, intraday. This is on a 1-minute basis, and the New York Stock Exchange tick. Now we have our own developed version of the market internals we call the advanced decline sync. All right, and again, that's available in our software. But this is I just thought I would show this for everybody because everybody's most familiar with this in terms of just the generalities of it and what it simply represents. What you see on the right hand side is our 750 tick chart. Now we primarily use tick charts in our room. I know some folks use range charts and Renko charts and various permutations, and all those are fine. I've just always used tick charts, and the trade setups and opportunities that we have do work on range charts. Renko charts are a little strange and the way they're calculated, so I'm not all that hip on range charts, but certainly time charts are fine, of course. All right. So what you're simply seeing here is each bar is 750 ticks. Okay. Now we use one of our primary indicators we use is simply the Commodity Channel Index, CCI. Okay. So again, like I said, I'm not reinventing the wheel, but the way we use it and the way we formulate our opportunities is proprietary to us. Okay. So simply the category of trade opportunities that we look at are simply called premium and discounts. All right, and simply a discount is an opportunity to buy relative weakness, all right, in a developing, sideways or up move, and then selling premium or high end of the range in relative down moves and so forth. So again, nothing novel, but statistically speaking, all right, we can pinpoint very accurately entries and opportunities, okay, without much fanfare. The computer will do it for us. And we have a new developed add-on to our software simply called the Scanalyzer Dashboard. Okay, and let me see if I can just pull this in. All right, if it's available here. I'm not sure. Let me see. Yeah, let me see if I can just pull this in to show you. Okay, everybody should see that Scanalyzer Dashboard. Now, this is something brand new. All right, it is available in Sierra Charts and NinjaTrader and soon to be TradeStation for those that have TradeStation. But here's the Sierra Chart version, and simply what this is different bar types. Okay, and again, this is fully integrated into Sierra Chart, pulling all the data from Sierra, but based upon things that we want to look at. And we can see what the current trend is. So Russell, NASI, and I have a few different S&Ps here, crude oil, etc. YM. You can see the current trend. We have our setups are categorized as a bull stacker, a bear stacker, premium discount, and a what's called a 200 extreme. So this actually automatically scans. So in essence, my program myself created an algorithm to just simply scan a database, and we can use up to, I think this has the ability currently up to 10 different names, but we can make it 20, 30 names. I mean, it's expandable to view, to search for specific setups. Right? So, we talked about how the humans are, get tired easily, right? Well, this particular dashboard will just simply keep running, and it will highlight not only visually but audibly our setup. So you can see here at the end of the day, NQ here on the 500 tick had a premium signal. S&P on a 1500 tick had another premium signal, and they were in bear condition. All right, so this is something that is relatively new with us right now. So just let me step you through what we were seeing today and kind of rehash the OODA loop a little bit and what we're talking about in the decision model. Okay, and now, but before I do, what I was alluding to a little bit earlier was for those that have Sierra Chart, the replay feature. Okay, if you've never used the replay feature, it's fantastic. Okay, you can simply go in there, and if you wanted to replay this particular day, all right, it'll simply queue it up, and you can change the speed, and you can simply go through the day and review opportunities that you may have missed, or you want to review something. If on a weekend, weekends are great. If as the fall and the winter is coming, most of us are unless you're a winter athlete, a lot of you stay inside. It's in the warmth. Well, this is a good time to really use the replay feature in the chart. I have begun starting using it myself. All right, I know it was always available, but with other distractions, I am using it now. And I put a video out recently. I think it was, what I did was I simply went in there and I just chose a random date. Okay, so it's great if you knew what happened on a particular day, and you could say, well, I know what happened on that day, so I'm going to review that date. So you almost know what's coming. Well, there is some educational value in that, but at the same time, it's a little different than to say, you know what, give me a date in September. So what I would ask anybody, okay, give me a date in September, and they give me a date, and I'll just go in there and put the date in, and it's okay, let's replay that. So essentially, I do that with myself, not knowing what's really going to happen or recall what happened on a particular day. Just go in there and use the replay feature. So if you haven't used that, by all means, that is definitely a bonus, and it's really easy to use. So getting back to what we were doing today in the OODA loop sequence and how we were viewing the market at the time. All right. So relevant information. What do we got relevant? I got New York Stock Exchange ticks. I got advanced decliners. That's giving me all I need to know. There is nobody on CNBC that's going to tell me there was weakening condition here at at 11:50 Eastern time. Okay, there was nobody on StockTwits that was going to alert Polaris Trading Group members, all right, that hey, watch it for that because we think it's going to go down. You have to do this for yourself. Whether if you're currently in an educational room, you need to. Now we don't call trades out in our room, by the way. Just I know I usually get some questions. There is no technical trade calling, although I will set everybody up in terms of what I think the current conditions are and where it favors the trade. Simply the computer through that Scanalyzer dashboard and the charts here, as you'll see these arrows and stars, actually give us trade opportunities for us on a day-to-day basis. So, what my job, how I view my job is to keep everybody focused on the correct side of the market action, keep everybody out of harm's way, keep everybody focused on what the relevant information that should be viewed on a day-to-day basis, all right, throughout the session, all right, as energetic as I possibly can because I get tired like everybody else, all right, and so I try to do, but I try to provide the best information and analysis as I possibly can. And again, in a very dynamic, chaotic environment, especially we've seen the past, couple weeks with the volatility in VIX getting up to 2830, and 50 handle ranges, 20 handles in a matter of minutes, it can be, talk about challenging. Okay, but now things have calmed down a little bit, back to a little bit more normalized trade, if there is normalized trade. So what we were looking at this morning, and again, I don't know what you were looking at this morning or how you were interpreting the market, but now this is only a small segment of what we look at. We have larger degrees of charts that we look at to give us a broader view of the bigger picture. So this is only a very small slice of it. All right, so just bear that in mind. But as price was moving up, into those highs, we simply were maintaining a bullish bias. Now, a lot of people, you could be saying, well, the market's going to, sell off later on, and it obviously it did. But in the morning, we didn't see anything that gave us that information. Okay, so again, it could have worked out that way, or today could have continued continued on its march from yesterday. Okay, but what we do is we evaluate what's the current information that we currently see. So what you see here, the yellow and white lines here, is simply our proprietary average true range, what we call structure lines. Okay, so as long as price is above a structure line, okay, it is bullish condition. So you'll see an opportunity such as what we call a discount here, and again, here is the alert, and it is live. All right, there is no delay. All right, it's not 2 bars, 3 bars later, and oh, you should have seen that one. No, these are live. And by the way, as I mentioned, these flash live on our Scanalyzer dashboard. Okay, so there is no, oh, I'm missing a trade, I didn't see that one, all right, type of thing. So we were looking for longs, and this is so what we would say, okay, so we got if on a pullback. Now again, you can frame out the market here. You can say, they hadn't taken out any highs here, all right, and I believe this particular low was a higher low, so there was a higher low sequence here, okay, in today's action. And you see these are higher lows here, so it's important that we get higher lows, because unless you take out a prior low, all right, it's more likely to go higher. So as a matter of fact, here's a great example that we saw, and I was discussing this live right past the opening, is that see these 2 bars right here, okay, on the left hand side? Well, we simply just drew a line, live in our trading room at the time. It was saying, price was correcting down into that level, and I said, well, if I think it was the 33 level, if the 33s hold on a pullback, okay, we would be looking for a bounce that would take us, or take price rather, all right, up to and retest the prior high, if that held. If it did not hold, okay, then there's an opportunity then perhaps that the market may push down and retest that low, all right? So that's exactly the framework of what I just showed in the prior slide, but this was live. And so what we were doing here is, when prices come down, and prices can move very quickly, a lot of people say, oh, it's going to break, it's going to break, it's going to break. Well, we don't say that. Okay, we simply observe what's happening. Yes, price is coming down, and at this point I know we did not have a position, long or short at the moment. But I said, well, if the price holds these, this prior zone here at the 33s, there's a good chance that, prices move back up and retest the upper level. Now, that's not prediction, that's preparation and using the relevant market information. So again, the OTA looping is simply orientation, observation rather first, orientation, decision, action. So the orientation and observation is market had pushed up pre-pit session, pulling back, all right, and then we simply, we have an up move going, but we have a correction with the context of an up move. So if it held, then if it pivots, we want to be buying some, let's just say right over here. Okay, I put a couple big diamonds there. Now we're not trying to pick the low itself, although we can take a nibble there and then add to a position on the way back up. That's what we prefer to do. All right. So in this case, the probability then favored once the market displayed to us, right? Trade what we know, verify what we see. Displayed to us that buyers stepped in and the sellers dried up, right? And the buyers came back. Then that's when I want to buy it. Boom, let's buy it right then and there. Okay, because that's where the lowest risk is and greater potential for reward. So this was a nice reward risk ratio, okay, as it ultimately played out. Now, again, keep in mind, I'm discussing this live, not knowing that it's going to get up to that level, but rather I'm just discussing that if you want to buy that, buy it on the right side pivot rule and then, target up at the upper zone there, okay? So as the market progressed, and I'm going to kind of move along a little bit quicker here. I don't want to spend too much time here. I want to get to one other aspect of what we do. Is it simply a decision discount? So higher low, price pushes up, okay, pulls back. So the decision then becomes, hey, discount is giving us an alert. So the computer, the software is giving us an alert. The structure in price, as you see this white line here, is bullish. All right, that's a decision I want to then buy. So I want to buy this discount, and we have an alert price there as a reference to enter at. I want to buy that discount. So if this discount remains valid, now again, I don't know 100% that it will, but the context of which I'm making that decision, all right, supports a bullish setup. So as you can see, entry at 38, and we got at least a couple handles out of it. Again, another retest, and then continued higher lows here. And then at each one of these little minor pullbacks here was opportunities to continue looking for buying opportunities. Now, once it finally hit the high here, and this is kind of where I want to get to, is you can see the highs here. So let me look at the global crosshair here. So at these highs, okay, so it made a higher high. Well, look at on the left-hand side here where the advanced decline line is. Okay, so the advanced decline lines were actually making lower highs as the futures. Now again, advanced decline line are cash equities. The tick readings were not that strong as we saw earlier. They were only about 500. All right, earlier they were up to 800, near to 1,000. But at a higher high here, so this was kind of some first evidence of some weakening or some divergence. A lot of people like trading divergence. Well, we don't just automatically short that just because it's divergence, but we are alerted to the fact that the price is getting weaker. Okay, so let me advance the chart here a little bit, and I'll show you exactly. Certainly, you know what happened in the afternoon, but how we viewed the weakness. All right, and again, through our OTA loop, observation, orientation, decision, action, we can make very relevant decisions, all right, timely, okay, and our software gives us some of that that info for us. So here's a couple discounts that you can see that actually played out, but they didn't really play out in a big way. So many of these discounts actually go for much more than this one particularly did, but there was some underlying divergence in the market internals, as we just saw. Right now, this little area right here, see where it becomes dark green and then yellow. Okay, now we're still up near that high. Well, this is some first clue to us through our software that is telling us that the market is becoming weaker. Okay, and again, this is right, if you notice, it's right at noontime. This is where I left off with our members. I'm saying, folks, I'm saying, you know what, the market's weakening. Before I go to lunch, the market's weakening, and we could see a pullback in price, very soon. And once this white line shifted, and I'm going to put a vertical line to identify the shift. This is what we call a point break. Once that shifted right here in this yellow area right here, all right, this is where our astute traders in our membership, knowing what the market is showing us at the time here, all right, establish shorts. Now again, I went to lunch, and unfortunately I didn't establish a short myself personally, but I did leave it for everybody to establish, their positions on the short side there. Now again, nobody here, nobody out there in the world told us what to do and how to do it and so forth. This is basically observation, right, through use of relevant information, right, knowledge of what we're seeing, right, and then trade what we know and then verify what we're seeing. So we're taking out this pivot low here, making a minor new swing low. We got what we call a structure or a point break. This is a short right here. Bam. All right. So that's an opportunity. Now, if you're looking and using other type of information and not focusing on a decision process, and that's what this webinar is all about, is to give you a technique to make those decisions. Okay. Observation, orientation, decision, action, the OTA loop. And this, if this, then if this then that. All right. So if this makes a new lower low here and then shifts the ATR line, all right, then I want to short on a break of that low. Okay, I want to short on a break of this low right in here. Okay, so simply then the action cycle, it becomes pretty straightforward. Right, you can sell stop, market orders, whatever the case may be, and you simply place your orders into the marketplace and position yourself accordingly. But if you're not looking at this in an objective fashion and understanding what's happening, then then you miss out on some great opportunities. Now, as the day unfolded, you can see further opportunities that were presented to us in premiums. Now, again, these signals automatically fire and show on our screens. Okay, so these are all historical, actual live opportunities that we took throughout the day. Now, it doesn't mean you have to take every single one, but they do provide quite a bit of opportunity. Right, this one here provided a short opportunity, somewhere along this line. You can see how the ATR line temporarily strengthened a little bit and then broke, reestablishing short position. So instead of getting emotional and psychologically, crazed and emotionally, high pitched in a sense that the market's going down. Oh my God! Now, if you're long the market, yeah, you have reason to be emotional and have psychological distress. But if you're on the correct side of the cycle of the market, all right, pricing action, by using an objective decision matrix such as ours, that ODA loop, well, we know we want to be on the short side of the market. All day yesterday, as a matter of fact, we kept saying to everybody, all our members, there is no shorting today whatsoever. As much as you really wanted to think that the market was too high, there's absolutely no shorting. So when we get a shift like we did here today, right, there's absolutely no longs. Right? I don't care if you're trying to pick this low down here for the bounce, for the retracement bounce. Let that one go. You want to stay in alignment with the primary move. And then ultimately, we all know what happened, but I just want to kind of highlight throughout the rest of the day, some of the premium opportunities. How many do, again, as I stated earlier, as an intraday trader, we want as many opportunities as possible. Okay? So between our software and using the ODA loop sequence, all right, we're able to stay very much in alignment with the underlying action. Now these particular discounts. Now this was one, and when this was about 3 p.m. This was one right here that we had actually played. All right, on the long side. So price, there was some reason to get a bounce off of this level. Price came up, retraced. We actually took a long in here, and we got a little, 2-pointer out of it. Okay, now was that in direct contrary to the bigger trend? Yes, but the context of what we were looking to do here was just simply take a 2-point scalp type trade. Okay, and then these particular signals here never triggered to the long side. Okay, so these discounts here, as you can see them, we were saying, yep, there's a couple discounts there, but there's no triggers. So once there's no trigger, there's simply no trade. And as it turned out, the fact that price did not reemerged strong actually became a sell signal right in here. So and again, as you can also see, we got a point break right at the same time. All right. So again, staying in tune with the market, what the market is telling us, not what anybody on the talking heads or anybody else out there. Stay focused on the relevant information, and you will you'll be doing the right thing by yourself and staying in alignment with the with the market itself. That's what we want to do, especially as day traders. Okay, we don't have the time to play games that I think the market's going to be down tomorrow. If you're a swing trader and you want to take a swing type position for a few days, that's something different. But as an intraday trader, win, lose, or draw, you really must be in alignment, all right, with whatever the day's action is, and you cannot simply have a specific belief or bias, okay, coming in. Just let the market show you what to do, but read the market for what it's telling you, all right. And if you're unfamiliar, if you don't have good techniques, all right, again, come visit with us, and you can develop those techniques. It does take time, does take effort. Now, I know we're a little bit over here, but I want to get to the number bars that Patrick was talking about, and I think this is a great addition. And from the recent agreement that Infinity and Sierra Charts have created, it's simply free. Okay, so this is, I know many of you use other platforms that utilize, number type bars or delta imbalance bars. What I have done, I know there's a lot of lines here, but what I've done is I have created, taken the number bar sequence from Sierra Chart. I use a 1, 2, 5 range chart, so that's 5 ticks, okay, each bar. And I've simply overlaid a lot of the indicators that we use from other charts. So, for instance, and again, I'm just going to give a little plug here on some of the, and I know Patrick does this every Thursday. But what you can do is most of these indicators that I have here are actually being pulled off of other charts within the platform. Okay, so you can see this is a 1, 2, 5 range, but I'm taking indicators from the 750 tick execution chart. Okay, so I've simply overlaid those. So there's a lot of neat things you can do, okay, with Sierra Chart. I have found, now I've used TradeStation for years. I also use NinjaTrader to a degree. They all have great qualities, but simply I have found that Sierra Chart is so flexible. Look at the labeling here on the right hand side. Again, there's so many different things that you can do. What I do for our members is all the various charts that everybody sees. I create individual templates. So when you come in, and you join up and you want to either lease or buy the software or take a trial or whatever, you will use the exact same charts that we use. I don't give anybody else different charts that I don't use. So we're all on the same page. We're all looking at the same thing. There's no sense for me to teach something and you're not looking at the exact same, chart type, and signal that I am. Okay, so everything is very uniform in our membership, and so forth. Okay, so just let me summarize a little bit here. So let me just go back and kind of wrap things up from my end. But so in terms of summary, thinking in probabilities requires the trader to accept the belief, and this is important, the belief that random outcomes, given an unequal distribution of wins and losses, actually can produce consistent results. Now again, you just saw a series of premiums or setups. Those particular trade setups have a very high inherent or embedded probabilities of success. Okay, does that mean every single one of them works? Absolutely not. Right? Because again, context is really important. And that's what I teach in terms of what we look for, and then we take the signals from our software, right, and apply them. All right, which is a good discount? Which is a good premium? Which one should I perhaps avoid? Okay, these are the things that we learn, in detail with our members. Okay, and again, if you're somebody that is searching for a methodology, all right, and not quite, or you're unhappy with the current one, again, come check us out. Okay, but what we want to do is we want to stack the odds in our favor. And as a matter of fact, interestingly enough, again, I'm just going to bring the dashboard back in. Look at the name of the Stacker Bull and Stacker Bear. Okay, interestingly enough, that the name that we created, and again, our members, help create some of these names. But the names that we create as the Stacker Bull, Stacker Bear simply means that we are stacking the odds of those particular trade setups are very difficult to beat, okay, because the odds are truly in our favor. So, like the casino, we want to stack the odds in our favor, all right, on not only particular trade setups, but having a greater number and magnitude of wins. It's not just the win-loss ratio, but it's the magnitude of wins, right, versus losses over a large series of trades. Not one or two or three or four, but, And then again, each trade is statistically independent. Just like blackjack, sitting there, every single one of those premium and discounts I just saw on the screen has no bearing to the one prior to the one next, following it. Okay, it's individual. But the context in terms of whether it's an uptrend, downtrend, where it's occurring does matter, but they are still statistically independent. So simply to exploit any edge, you have to take every single trade that's valid. Now, there are those that aren't valid, all right, and again, we teach that, but you want to take every single valid one. So by utilizing the PTG OTA loop decision matrix, it will keep the trader focused on relevant information necessary to make the more knowledgeable trade decisions. Now, isn't that what it's all about? Is to make good decisions? I say to our members, on a day-to-day, week-to-week basis that I want to help you become a better decision maker. Okay, I am here not necessarily to teach you how to trade, execute an order, and so forth. I mean, there are plenty of education out there, but most of our members come with some experience, and I'm here to try to bring everybody's trading to the next level wherever they are, bring them individually to a higher level. Okay, and everybody's in our membership is at a different level, so nobody is. It's not a static environment. Not everybody's looking at the exact same thing each and every day, though the presentation and moderation is focused for everyone. But it's becoming more knowledgeable in how we make our decisions, and having truly a specific technique. Like I said earlier, I have read and I've gone to other webinars, and people have spoken over an abundance of, you got to trade like, think like a trader, think like a professional trader. And my question is always, well, how do you do that? I mean, I would be asking them, what technique do you have? And I would never get a response. Well, again, I took it upon myself, several years back to adapt the OTA loop from Colonel John Boyd, and so since the computers are programmed to identify, to exploit, probabilistic trade opportunities, right? We as traders need to develop similar type skills. All right, that'll aid in our specific opportunities based upon whatever methodology we're using. So simply at the end, those if-then-else conditional statements, right, is what we use, right? And in looking at, what the market is giving us at the time, is there a trading opportunity? Is there a signal? If if this, then that. Okay. Otherwise, we're just continuing to observe and orientate ourselves. And that simply keeps us in the now moment, okay? In the now moment. And lastly, that's the summary of it. But a lot of the information that I have presented here today, I've taken, concepts from those people that you've probably read about, okay? Staying in the now moment, right? Mark Douglas, the disciplined trader. Dr. Brent Steenbarger is absolutely fantastic. He runs the Trader Feed blog. You should check him out, all right, on a day-to-day basis. And he's back to blogging. It's just a wealth of psychological, helpful, information, talking about beliefs, probabilities. Van Tharp is absolutely phenomenal as well. These are all, resources that I think every professional trader should endear themselves to. All right, and although I have taken concepts from various of these authors, and spoke about a little bit today, the OTA loop is really taken from Colonel John Boyd, which if you read about him, his nickname was 42nd Boyd, and simply, the reason why his nickname was 42nd Boy was because he challenged all the top fighter pilots of the day that from a position of disadvantage, in other words, he's being the defender and the other guy's the aggressor, he'll gain the advantage and shoot the guy down, figuratively speaking, right, in a mock dogfight. He won every single one of his challenges, and he did it within 40 seconds. So think about that, right? He developed the OODA loop. Well, if it worked for him, and he never lost a dogfight, never lost a dogfight, not one, right, in recorded, never lost a dogfight. Well, is it going to help? I think it helps us as traders. I know it helps our members, and hopefully it'll help you folks as well, all right, if you're interested in learning more about it. So lastly, before I give the floor back to Patrick, because I know we all want to go home, and I really appreciate everybody staying as long as you have, I'd like to offer everybody that's attended today a 14-day free trial to the room, and it also comes, if you're interested in a concurrent PTG software suite for Sierra Chart as well. All right. So with that, I will be happy to hand the floor over back to Patrick. And if you need to contact me, there's my contact information. Certainly contact either Patrick directly if he's your representative, or your Infinity Futures rep for further information of how you can hook up with us in our software and so forth. So by all means, come check us out. Just go to the website, sign up for a free trial, and you'll get an automated response, get you right into the room lickety-split. So thank you very much for your attendance. I know it was a little bit longer. This is more of an educational rather than just an informational webinar, and I appreciate your time and attendance. So pass it over back to you, Patrick, if you want to grab it. Thanks very much, everyone.
For a second, but I want to show people where they can get this, and I want to remind everybody too about exactly how to get to this specific spot. I'm just having a little issue with my browser. David, you know what? You do me a favor if you can, and just open up a web browser and go over to your website. Actually, you know what? I got it. I'm sorry.
You got it?
I'll do
Okay.
it from here.
Okay.
All right. So let me take the screen back real quick. Let me show you guys what I'm talking about. So if you go to PolarisTradingGroup.com, and I'm about to show my screen here, so sit tight. Okay, so if you go to PolarisTradingGroup.com here, folks, this is David, and go to free trial here on the right side. Okay, so you click on that, and then you're going to put some information here. This is, you may see something, right, David, about it being a 7-day trial, but it is a 14-day trial, right, David?
Yeah, that's correct. If
Not panic when they see that.
Yeah, that's correct. If you get a response, an auto response that says 7 days, don't worry about it. We extend it to 14.
Everybody, we got a few questions about that last time. So this is where you're headed. Again, go to PolarisTradingGroup.com. Click on the free trial button on the right side. I'm usually in the room every day, unless I'm running too many things here, and if I can't participate, I don't join. But feel free to come back to me directly with questions. I think that based on my knowledge of the people who are here, I can tell you right now there are definitely some names that I see here that could benefit um, from David's calm and collected approach to this, especially over the last few days. I've had a lot of conversations, pep talks over the last couple days, and I can feel the volatility cracking people just a little bit, and that's all it takes. As you guys know, I mean, this is a very unforgiving market we're in right now, and with futures and leverage involved, the fact that what happened yesterday may not happen today or tomorrow. It only takes one slip up to really get yourself in trouble. So keep your head screwed on nice and tight. I think that David could be a good resource for you, and that's one of the reasons why we talked about scheduling this presentation, and also we wanted to do something a little bit different than what we normally do, and hence the first part of this, the whole presentation, but specifically the first part being a little bit different than what we've done in the past. So definitely good stuff, David. Appreciate your time and sticking around so long. Everybody here, thank you for coming to the event. Feel free to take us up on this offer. David and I are working really hard together. He's busting his behind working on the updated charting package. He's got one of the best integrations with Sierra Chart that I have ever seen, with the way that he can automatically install the chart books for you just by having a trial of our program or having a live account with us. It's super easy to get them up and running, the easiest of any group that I think I've ever worked with. So take us up on this offer. And if you have specific questions, obviously you can come back to me directly. You can talk to your rep in our office. We'd be happy to assist you and get you squared away. And again, David did mention this thing about the level 5, being free here. This is a 2-week-old development. It just happened. So if you've ever been on the fence and you're looking for a really nice, market profile style or volume profile, numbers bars, as David mentioned, style chart, this would be a great reason to check us out as well. So you're welcome to try a trial of the program. But thank you again, everybody, for coming. I'm going to go through some risk stuff here real quick, and then we'll just close the room up. And please keep in touch. And thank you again for coming, everybody. Appreciate it very much. Thank you, David, too.
Okay, thank you, Patrick, and again, thank you, everyone, and good trading to everybody.
All right, folks, have a great night. Trading futures, options on futures, and retail off-exchange foreign currency transactions involves substantial risk of loss and is not suitable for all investors. You should carefully consider whether trading is suitable for you in light of your circumstances, knowledge, and financial resources. You may lose all or more of your initial investment. Opinions, market data, and recommendations are subject to change at any time. Past performance is not indicative of future results. All right, folks, thank you again. Have a great night. Bye-bye.